Welcome to our Basic Accounting webinar. My name is Virgil Dismeyer, and I will be your SCORE host today. This webinar is designed for those people who are not familiar with accounting or those beginning new business owners who have never faced accounting issues or software users frustrated by their accounting software. We will try to take the mystery out of this key topic for any successful business. Because of the semi-technical nature of the topic, we suggest you print out the slides so that you can follow the discussion and make notes. This is a recap of our intended journey together. We are not going to make you an accountant. Keep in mind as we go through the discussion that the numbers I have used are for illustration only. Don't get hung up that they do not reflect your type of business, since accounting theory applies to all types of business. This is a definition of accounting and bookkeeping. Many times the terms are used interchangeably. Accounting is the measurement, processing, and communication of financial information. Bookkeeping is the process of recording financial transactions, either by hand or on a computer. Many small business owners use third-party vendors to perform these functions. Well, if you can hire someone else to do it, then why do you need to know accounting? Even if you use a third party to actually do your accounting, you must still understand what the accounting statements for your company are telling you. As a business owner, you will be needing to be aware of some accounting forms, some reports or analysis for most external transactions. You have to understand the basics of accounting just to communicate with your bookkeeper or accountant. No small business can survive without understanding the scorecards for their business. We will use a lot of jargon, just like every trade does. I've been an accountant for over 60 years, so the jargon is second nature to me. In the next few slides, we will discuss some of the more common terms you will encounter. These terms are universal for most businesses, but may vary for nonprofit entities. Many business owners who use a third party to prepare their accounting reports should set aside time each month to have that person explain the statements so that over time they can interpret their statements on their own and understand the signals that those statements are sending the owner. Your business will use many individual accounts in which to accumulate transactions. For example, you could have an account for a checking account, a building you own, each loan that you have, equity account to reflect your equity in the business. But whether you use 100 or 1,000 accounts, they will be grouped in the 5 categories on this slide. Income, expenses, and expenses include cost of goods sold, depreciation, and bad debts. Assets, things that you own, liabilities, things that you owe, and your equity. Those are the 5 categories that all accounting transactions fall within. This slide illustrates a concept called double entry bookkeeping. For every debit entry, there must be an offsetting credit entry, and the two must equal. Computer accounting software forces this equality. As an example, if you make a credit sale, the entry would be accounts receivable, a debit, $1,000, and sales, a credit, $1,000. We will explain this more fully on the next slide. This scale depicts the effect of double entry accounting. The scale is in balance, or the amounts of debits and credits plus equity are equal. For someone new to accounting, the last point is key. Always think, where is the offsetting entry going to appear for the amounts that you are entering? For example, if you buy a truck, you have a new asset, and you will reduce your cash asset by the purchase price. Or you may increase the loans that your company owes, but there is an offset to the truck that you purchased. These two simple balance sheets illustrate the double entry accounting concept as a financial statement. In the first case, the owner funded the business themselves with cash, property, a patent, so their equity is the investment for those assets, or $25,000. But this is just the beginning. The business needs more resources to function. In the second example above, the owner borrowed an additional $75,000 to launch the business. The debt was added to cash, so the owner could then purchase inventory, rent space, and so forth. But notice, the assets, liabilities, plus equity are always in balance. You will hear a lot about the chart of accounts. It is the core of all accounting software. You must spend time and maybe hire an accountant to help you set up your individual accounts in the PC software you decide to use. The chart of accounts will dictate what captions appear on your statements, what buckets you will use to record transactions within, and what is important to properly manage your business. QuickBooks allows you to use numbers to represent each account, or you can ignore the numbers, but the structure will still be as reflected above. This is just a default suggested chart of accounts that QuickBooks provides to a new user. It is based upon their experience, but it may not be how you want to manage your business. This sample illustrates the 5 types of accounts. The accounts in the 1000 series are assets. The 2000 series are liability accounts. 3000 are equity accounts, or your ownership. 4000 are sales, and the 5000s are cost of goods sold, or the cost associated with a sale, and the 6000s are expense accounts. If one of your accounts is telephone, you may want to track types of telephone expenses by using sub-accounts. You could include sub-accounts for landlines, long distance, and cell phones. It is up to you. How much detail do you want in your statements, and what is important for you to manage that company? The General Ledger is a historic record of every transaction that has taken place for your company. It can be used as an audit tool or basis of evaluating why some accounts have an unusual balance. Again, if you are using PC accounting software, this ledger will be invisible. The PC will keep track of it, but it exists as a large database of your business and its transactions on your PC hard drive. Let's move on to non-cash transactions. These are transactions that do not involve the receipt or payment of cash. A journal entry is the means to reflect transactions that do not use cash. We have illustrated two such journal entries here: depreciation of a fixed asset and the write-off of a customer's accounts receivable as a bad debt. You will see that on depreciation, you have depreciation expense, and the credit is reserve for depreciation. And that reserve reduces the asset value of that truck that we mentioned earlier. We will cover depreciation in the concept section of this session. There are four basic financial statements that you will include in your business plan. These four will be discussed individually and are listed here. QuickBooks itself offers about 40 different financial statements depending upon your need. QuickBooks has a report for accounts receivable aging, sales by customer, fixed asset by asset type, and others. So your financial statements, the key ones, are these four on this slide. The first financial statement is a balance sheet. This slide illustrates the components and describes what each section reflects. Remember, equity is your share in the total business. A balance sheet can be deceiving because it usually is based upon the cost of the items and not the current market value. If you are buying a company, the assets may be overstated, obsolete, understated, or the value has grown, like in the case of a building. Equity is often referred to as net worth. Equity and net worth are the same thing. And in theory, if you sold the assets, paid off the liabilities as reflected on your balance sheet, the equity is what you would get as the remainder of the sale. Here is a sample balance sheet. That balance sheet is probably the least valuable of your statements because, number one, it is a snapshot at one point in time and constantly changes. Second, the values may not reflect the market. And three, it does not include values like goodwill, a customer database, your brand, and others. And the liabilities may not reflect lawsuits that are pending or accumulated unpaid interest. Be careful when looking at a balance sheet. This is another sample of a balance sheet taken from QuickBooks. By now, you should be familiar with the debit and credit sides of these statements and the fact that they always balance. Two components above that are difficult for some to grasp are inventory and accumulated depreciation. We will discuss these under the concept section of this presentation. Now we're going to discuss the profit and loss statement. This is an overview of the chart of accounts that is utilized. As a quick review, remember that the income accounts will have a credit balance. The expense accounts will have a debit balance. The net of the totals in all accounts should be a net credit balance, which equates to your net profit for the period being displayed. Let's look at some profit and loss examples. This is a very simple profit and loss statement. It shows a net profit of $1,286. If this statement had resulted in a loss, the net loss would be shown in parentheses or on a color printer in red. The next example is more typical with more accounts and is more complex. This is a typical profit loss statement for a business that uses inventory versus a service-based business. There is a net profit of $35,199 at the bottom of the statement. It is called net income here, but it is the same as net profit. These two captions are used interchangeably. There are two key figures in the middle of the page. One, cost of goods sold, is the amounts for which the products cost that were included in total income. For example, if your company sold books, the cost of goods sold would represent buying the books from the publisher. Remember that a product-based business will show a gross profit. This is a very key figure. A service-based big business will have no cost of goods sold and no gross profit margin. The second ratio in the middle of the page is the ratio of the cost of goods sold to total income. It is called gross profit margin. This is a very important ratio. You will be able to compare your gross profit margin to other like businesses using a database at your library called Risk Management Association Statistics. Lenders will use this ratio to see if your projections or business is typical of others in the same industry. So you should get used to comparing your statements to your industry segment. For new entrepreneurs, it is difficult to grasp that the net profit of the business is not the amount by which the checking account balance increased. The reason for this is that the profit and loss statements contain accounts which do not use cash. Depreciation is an expense, for example, but does not reduce your checking account balance. Your checking account will reflect the net profit of your business, plus any purchases of capital items like a truck or cash withdrawals by you, the owner. The difference is what creates the need for the third type of statement called a cash flow statement. This third statement we are going to discuss is the cash flow statement. This may be difficult to understand at first, and you should study it on your own using the printout of our slides. But remember, it shows changes in both the profit and loss statement and the balance sheet. It reconciles the cash figure on the balance sheet to the net profit on the profit and loss statement. There is a fourth statement that you will use occasionally. It is not a part of your ongoing financial statements, but this statement is a part of every business plan that you may develop to launch a business. On slide 8, we saw the balance sheet of a startup company. This statement answers the question a lender or investor may ask. How much money do you need, and where is the money coming from? Every one of these statements will list the owner's equity investment, which will be used to fund some of the startup needs. No vendor or lender will lend you the total cost or amount of money that you need to launch your business. You have to have some skin in the game, and that is your equity. This statement shows a need to fund the loss before the break-even point, and we will look at that number next. But remember, you probably will not make a profit the first month or maybe even for the first year. So you must ask for enough money to carry you forward until you do make a profit. Now we will shift our discussion from the statements themselves to underlying accounting concepts. These concepts govern how certain financial transactions are handled, and you should master them to understand why certain transactions are more complex than others. When this session is over, you will be able to assimilate debits, credits, financial statements, and concepts. They are all interwoven. We will discuss each of these points on the slide in our next slides. Cash versus accrual. There are two methods to record financial transactions. The cash basis records activity when cash is actually received or paid out. It is by far the simplest and used by most startup companies. The accrual basis of accounting records activity when a commitment is made based upon the calendar, such as a purchase order to buy one of your products, or you have accrued interest on a loan. Most startup companies will use the cash basis until the accuracy of their statements is distorted by ignoring outstanding sales or purchase commitments. The IRS waives the annual requirement for small businesses to use the accrual basis of accounting when they use inventory if their sales are less than $1 million. So a small business basically should start on the cash basis and move to the accrual when it is appropriate. Break-even analysis. This is a graphical depiction of when a business is projected to turn a profit for the first time. All startup companies or new products will have a net loss during their initial launch. Since this is complex, we will discuss each point or number. Number one is the horizontal line, which is your fixed cost for just being in business. It is easy to project because it covers things like rent, insurance, utilities, and other expenses. Number two is the variable cost, and that's this line here, that are added to fixed cost. A variable cost is what you incur for each item you sell. For example, for each book you sell, you have to pay the publisher the cost to buy that book. 3 is the sum of the fixed and variable cost, and that figure goes right along here. And it is based upon units of sale. 4 is your sales projections, and that's the hard red line, starting at 0 and growing with the units of sale over time. Number 5 shows sales exceeding your fixed costs. That's the green blob on this chart. This is your basic break-even point just to be in business, but you are still losing money because you are not recovering your variable cost. 6 is the true break-even, which is that white oval. Sales equal fixed and variable cost, and any sales after this point will generate a profit. This is a good chart to keep on hand. Inventory. We will use 3 slides to discuss inventory and cost of goods sold. Inventory is an asset value on the company's balance sheet. Inventory can use a lot of cash, so it must be managed to avoid back orders from customers, yet also avoid obsolescence and write-off. Inventory is usually recorded at the cost of purchasing the item for resale. Inventory is the key element in calculating cost of goods sold, which we will illustrate on the next slide. This is important to understand how to calculate cost of goods sold if your business sells items versus services. Inventory may include the basic cost of a component, but you may have to package it for sale and perhaps incur labor costs to present the item as a saleable item to the customer. All of these costs are charged to inventory as a balance sheet item for the business. Periodically, a business will take inventory by counting the actual saleable items they have in the warehouse or on their sales shelf. If every item is counted, then the business owner must use caution in assigning a cost to them. For example, if you count an obsolete item, but then you must assign a 0 cost because it cannot be sold. The total of all inventory items with a value becomes the new inventory figure on the balance sheet. The calculated inventory figure is then subtracted. And here is the calculated inventory on this slide of $6,000. Is subtracted from the accumulated cost to that point to determine the cost of goods sold, in this case $10,000. But whoops, that $10,000 may not be all cost of goods sold. Remember, that figure reflects a number of things. It reflects the actual cost of items sold, but it also reflects items that no longer have a value. It also reflects items that may have been stolen and not sold, or spoilage, particularly in a consumable items such as a restaurant. So cost of goods sold is a combination of many factors. The only good figure is the ending inventory, which is an asset on your balance sheet. Now, inventory requires very detailed subsidiary records when a business is based upon selling physical items. A small business has 2 options to record inventory transactions. We suggest you keep it simple. Ignore inventory and charge all purchases to cost of goods sold. This method does not match cost with sales, but the simplicity may be worth a degree of accuracy. The IRS allows this method if your sales are under $1 million. The second method is called the detailed method and uses a detailed record of each item or category of inventory. All purchases are recorded as inventory on the balance sheet, and then the periodic inventory shifts the cost of goods sold to the profit and loss statement from the balance sheet. This method is more accurate and matches cost to sales of products. QuickBooks does a detailed accounting for each item. It can then display profit by item or by category. Depreciation is another very complex and detail-intensive concept. For example, when an asset is purchased, like a truck, a building, or a piece of machinery, it is recorded on the balance sheet at its cost. Land may be purchased but is not depreciable. Most companies will charge off as a current expense any purchases of fixed assets if they have enough earnings to absorb the charge. It is simple and deductible on the tax return up to $500,000 per year and saves many hours of bookkeeping entries. The IRS has a predetermined set of rules, useful lives, and write-off methods that a taxpayer can use. Usually a company will use a third party to manage and record depreciation due to its complexity. Financial ratios is a way to measure one company with another or an industry. A key tool is to use a set of ratios by NAICS code maintained by the Risk Management Association. There are many ratios, but two stand out. Gross profit margin will reveal whether a company's costs are too high or prices too low. Return on equity is the yield on the dollars you have invested. Are they adequate for the risk, or would you be better off investing in the stock market? Every business plan contains a set of ratio comparisons for lenders and investors to judge the viability of the proposal. This is the fifth and final category to be discussed today. Because financial records contain so much detail, most companies will use some form of accounting PC software, which does a lot of the thinking for you. When you think about your accounting tools and methods, remember to always keep company and personal financial records separate. Do not commingle the two entities. A new, small company may rely on the same records that an individual would use for their personal life, a detailed check register, for example. This will suffice for a short period, but there is no capability in a check register to automatically prepare statements, classify entries by account, or perform other tasks. But it is a basic accounting record. The next step up from the manual system is the use of an Excel spreadsheet. With this option, you let Excel do the adding and create. It does require knowledge of Excel formulas and reporting systems. Unfortunately, you must record the Excel transactions by manually going through your check register. Excel is excellent for subsidiary records like sales and fixed assets. A company can use a PC accounting software to take much of the drudgery out of bookkeeping and financial record keeping. We have used QuickBooks from Intuit as an example, but there are many other choices that you can make. Using software automates the double entry bookkeeping we have discussed. It uses a checkbook format that is familiar to everybody. It provides a flexible chart of accounts and produces many pre-formatted reports. In QuickBooks, the database is your general ledger. When you use a software program for accounting, the chart of accounts setup is critical. Tailor the chart of accounts to how you want to manage your company. You can customize your own invoices and handle payroll if you want. It is also compatible with many bank systems. There are many resources for you to review to supplement this webinar. The screen lists 5 that you might consider. The last point should be stressed. Take any public company like General Mills and look at the financial statements they present to their shareholders. You will then recognize how these concepts look and are used in a real company. In addition to what we have or you have learned today, you are encouraged to seek mentoring at your local SCORE Minnesota chapter. SCORE volunteers know the local business community and can offer insight and other experience to you. If you're from outside Minnesota, we urge you to establish a relationship with your SCORE chapter in your local community. Visit the SCORE.org website to find a chapter near you. All you need to do is enter your zip code. Finally, if you have other questions, we have a dedicated email address to further serve you. We would be happy to discuss any points of confusion about accounting with you. Just send us an email. As a non-profit organization dedicated to helping you start or grow a business, we must make certain disclosures. We rely on various experts to present a topic, and the content is strictly for your education. SCORE Minnesota, nor any of its chapters, endorse any specific vendor or approach. Finally, any screenshots that I have used of websites or software is provided only for illustration and may not apply in every situation when you do your research. SCORE Minnesota is indebted to many people to develop and make these online and on-demand webinars available to you. The first is SCORE members like myself who have extensive experience in their field to provide the content. Second is Veritas Marketing, who has reviewed and guided us in developing each of the webinars. Their technical knowledge has been invaluable. Third is Wells Fargo, whose funding commitment makes it possible to finance the infrastructure to mount and maintain these webinars on the internet. With that, we wish you good luck and contact us if you have further questions. Goodbye and good night.